What are the pros and cons of trailing stops with longer-term systems? This is Bill Scheid from Applied Finance Research, and that's the question we're going to explore in this video. For this exploration, let's begin by talking about the pros and cons of trailing stops for trading systems in general before we look at longer-term systems specifically. So for the pros, trailing stops help us to protect gains. They move up with the price of a holding when it rises, which means that trailing stops can help lock in profits automatically. If the stock price begins to fall, the trailing stop remains at its last position, protecting the gains that the investor has made. Trailing stops also help to limit losses. So like standard stop loss orders, trailing stops can limit potential losses by automatically selling the position at the trigger price, and this helps to manage risk without needing to constantly monitor one's positions. Trailing stops also can help remove emotion. So by using a trailing stop, an investor can avoid emotional decision making. It automates the process so decisions are made based on system rules rather than fear or greed. Now, what about the cons? So one con is gap risk. Trailing stops may not be effective during periods when stock prices gap significantly, such as overnight or over the weekend when the market is closed. Prices could open below the stop level, and that could lead to larger than expected losses. Another con is that there's no guarantee of execution price. Most trailing stop orders turn into market orders once they're triggered, and that means that there's no guarantee that the sale price will be close to the stop level if the market is moving quickly. And this can result in lower than expected sale prices. And finally, we have market volatility. In highly volatile markets, a trailing stop might lead to an early exit from a position. So for example, if the stock price dips temporarily and hits the trailing stop before rebounding, the trader could be stopped out prematurely and then miss out on potential gains. Now, let's look at some of the pros and cons specifically for longer term systems. All of the pros and cons for general trading and investing systems apply here, but there are two other very important elements. So for the pros, trailing stops tend to reduce the size of maximum drawdowns in longer term systems. For the cons, trailing stops tend to reduce the total return of longer term systems. And it's these two elements that we're going to explore a bit further. The data in this table are a good example of this general tendency. These are from backtests that I ran using the Dr. Ken Long BMR bundle on TradeStation. These results are from a monthly system, so it is a longer term system, and it uses the ETF portfolio from the BMR 21 momentum system that we teach in our home study course. If we look at the 5% trailing stop, we see that we have the smallest maximum drawdown, but we also have the smallest ending equity. Now, as we increase the size of the trailing stop, if we're trailing by 5%, 10%, 15%, 20%, etc., as we increase that trailing stop size, we see that the ending equity tends to trend upward, but so does the size of the maximum drawdown. Now, this correlates with similar research that I've conducted with other long-term monthly systems, and it also squares with the work of other researchers. I heard Perry Kaufman speak at the London Society of Technical Analysts at an event organized by Jeff Boccaccio. Perry Kaufman is an American rocket scientist and quantitative financial theorist, and he said in his research that he has found that for longer-term systems, systems without stops tend to have the highest return. So to say it another way, the bigger the trailing stop, the bigger the return, but also the bigger the drawdowns. The smaller the trailing stop, the smaller the drawdowns, but also the smaller the returns. Why? Why do we see this tendency? Well, this tendency of trailing stops makes sense in the context of the belief that the long-term trend of the markets is up, and that the longer we hold, the more we take advantage of this upward trend. So a tighter stop means that our positions get stopped out and then the market continues to go up without us. A bigger stop means we're holding positions through bigger drawdowns, but then we're still in the market to catch the run up when things turn back around again and the trend resumes. As an example, here's a chart of the S&P 500 using monthly bars. The green line below the price bars is a 10% trailing stop. Now notice the bar that's circled in red. At that point, the 10% trailing stop gets hit, but then the market turns around and continues its upward trend. So if an investor was using this 10% trailing stop, they would have only had a 10% drawdown during this period, but then they would have missed the gains that follow. So in a way, using trailing stops with longer term systems is a little bit like buying insurance. The analogy is you can choose a higher deductible and pay a lower premium, or you can choose a lower deductible and pay a higher premium. Now, there is no right or wrong. It all depends on the objectives and the risk tolerance of the individual trader or investor. But an interesting question to ask is there an alternative? Is there a way to have our cake and eat it too? And it turns out that yes, there is. For long-term systems, using stops based on volatility are an excellent alternative to trailing stops. Here we have backtest data for the same monthly momentum system, BMR 21, and this compares the standard performance in the middle column to the performance when we add a volatility stop, and that's this right-hand column. If you've taken our courses, you know we like to often pair the volatility stop with short positions, but here we've isolated just the effect of the volatility stop, and that's what we're looking at in the right column. The first column, by the way, is the buy and hold return for the S&P 500 with no stops at all. And then our middle column is the standard performance of BMR 21, no volatility stop. So what we see here is that adding the volatility stop both increases the total return and decreases the maximum drawdown. The return jumps from 693.1 to 894.5, while the max drawdown decreases from 34.3 to 15.7. So we get to have our cake and eat it too. And note the impact that this has on our ending balance. Ending balance is a hypothetical account starting at $100,000 and growing at the compounded annual growth rate for the period of the backtest. So for the S&P buy and hold, we end up with $427,000. For BMR 21 without the volatility stop, we end up with $838,000. And when we add the volatility stop, we end up with over $1 million. So when it comes to longer term systems, while there are both pros and cons to trailing stops, there are also alternatives that work very well. This is Bill Scheid from Applied Finance Research. Thank you for watching and happy investing.